Let's chat DeFi. There's a lot of money in crypto doing DeFi, earning yield, earning good risk-adjusted yield, earning more yield at lower risk than you can get elsewhere in the world. This video outlines how exactly that's possible and an example of the best way to leverage all the benefits of DeFi to enable higher APY. Now, I think the best way to understand DeFi at a high level is to understand how it compares and contrasts to traditional finance. So these diagrams right here outline what TradFi is in the most basic sense. You have a consumer, a client, a customer, whatever, who deposits money to an institution. The institution gives that money to a borrower, and the borrower pays a percent interest rate back to the institution. The institution is a middleman. They don't control the money. They don't control what the borrower does with it. All they do is they route money from party A to party B, from this type of user to that type of user. Okay, this is how banks work. This is how everything works. How market makers work. How insurance companies work. How loans and credit unions and all these. It all boils down to this interaction right here. No matter what type of financial institution, you can more or less boil it down to this. This is the entire business model. This is one of the biggest industries in the entire world. Trillions of dollars wrapped up in traditional finance. The person who uses or who provides money to the middleman, they don't see the returns that the middleman gets. They might see a very, very small sliver of it, but realistically, the business model is this person gives money to this person, and this person pays this middleman for routing the money. Know that there is a circle around each of these because what the users are doing in one thing is not accessible to the other thing. So, for example, if I get a certificate of deposit on my dollars, and I'm going to have more dollars in the future, but I can't access them now, it's not easy for me to use that as collateral for a loan, okay? I can say I have $100 in a certificate of deposit that becomes available to me a year from now. I need to borrow $80 today, and I can pay you $100 a year from now. It's not easy to do that. There is nothing that makes it very easy for, let's say this is where I'm gaining this the certificate of deposit. This is where I'm getting the loan. It is not. There's no easy way for this and this to chat with one another. That's TradFi. Understand that the middleman activity here has differing levels of human decision making, but all of it boils down to a very formulaic process. Looking at things like, for example, let's say this is a bank right here. Who can deposit to a bank? There's some criteria. Basically, everyone. Who can take out a loan from a bank? Well, that's going to depend on their credit score. That's going to depend on the size of the loan, their other assets, their net worth, their income, what they're using the loan for. These are all This is a very formulaic checklist. Now, DeFi says this person isn't doing jack fucking shit besides making mistakes because it's a human. What if we replace this human in the middle making highly formulaic decisions, inputting their typically bad judgment every now and then? What if we replace them with a smart contract? DeFi looks almost the exact same as TradFi, except for a few key differences, which I have written out here. First of all, revenue share. The person who's supplying assets into the DeFi protocol, they get a share of the revenue. The smart contract facilitates that interaction in a way that is even more so formulaic and even more so bulletproof and even more so automated. And the supplier who's paying interest, the borrower who's paying interest to borrow money from the supplier, they don't pay all the interest back to the smart contract. They pay the interest primarily back to the supplier. So that's the first element to understand. The second element is that there are token incentives. If you can understand that this industry exists and is worth trillions of dollars, and you can understand that this has the potential to do its job better than this, then there is a massive, massive, massive opportunity to invest in whatever this is. And with that, you have these protocols outright, or the investors backing them. They are paying people rent, essentially, in token incentives to use this platform. The flip side to DeFi is that because everything is written in code, because everything is on chain, because everything's very formulaic, it's very easy for me to copy this and make my own. Okay, so this is version 2 of the same thing. I just forked some code. How do you get people to use the real one and not the fake one? You pay them. You pay them to use it. You pay them rent, basically. The third step is that this walled garden is no more. Everything's happening on chain. This contract can see what's happening over on this contract. I can do stuff on this in this protocol right here, and I can leverage it to also do something in this protocol. Going back to my first example, if I have some locked up position, I can still use that locked up position to take out a loan, because I know that position will unlock and it'll be worth so much, and it's possible to take out a loan pay the interest rate and then forfeit some or all of my locked up position when it unlocks. Okay, that's all there is to it. And understanding the way that you can best earn risk-adjusted yield in DeFi is finding good strategies that combine all three of these. The revenue share is the best example of higher risk, higher reward. Okay, if a protocol is riskier, dealing with volatile assets, and putting it to work, nonetheless, you might get more revenue share than something that is very, very, very straightforward and very, very impervious to losses of any type. So a higher revenue share typically translates to a higher risk. However, number two here, and number 3, the token incentives and the leveraging across multiple protocols, that's where the money gets made. Like I said, I can take this protocol and I can copy it. And perhaps this protocol is the exact same thing as this one, but someone with $1 billion doesn't like the way this one's ran. And they're going to contribute so much fucking money for you to use this one and not that one. That's one element of increasing yield without necessarily increasing risk. You are getting paid to use their product. Their product isn't necessarily riskier if they're paying you more. It could be all kinds of different things. It could be less known. It could be it doesn't have big influential cheerleaders backing it. It's newer to market. The incentives are fresh, and so people haven't migrated over. The incentives that were good somewhere else eroded. Number 3 is leverage. DeFi is very composable. Your interactions in each of these protocols have basically on-chain receipts. Sometimes you can use your receipt here to do something there. And a lot of these protocols are designed with that in mind. They want to, in the similar way that they're incentivizing TVL with tokens, they want to figure out ways to get the most activity to their platform. If the protocol here and the protocol here determine, hey, we could actually hook our protocols up together, it means that all of these people are now doing stuff over here. All of these people are now doing stuff over here. That is huge. So, first of all, if this is completely new to you, don't do shit in DeFi until you understand what each of these individual protocols are. You can go over DeFi Llama. There is over $200 billion in TVL in crypto DeFi today. Start by figuring out what these top 10 do. Understand what each of these do. Some of these are forks. Some of these are totally new. A lot of these work together. Figure out what these all do. Figure out how they work together. That's a good enough selling point. Most of the stuff down here is forks from stuff up here. Not everything. Some stuff is new, but that'll give you a good footing. If you cannot look at each of these and within an instant tell someone in 20 seconds or less what each of those do, don't do DeFi. I could do that with all of these. Curve, like asset, automated market maker. Lido, liquid, permissionless staking on your Ethereum. Maker, over collateralized stablecoin mintage. Anchor, under collateralized stablecoin mintage. Aave, peer-to-peer lending market. Convex is call it a lobby on top of other protocols like Curve for voting. Uniswap, permissionless automated market maker for any assets you're interested in. Compound, peer-to-peer lending market. Instadap is basically a handholder or a helper that exists on top of all these apps. PancakeSwap is a fork of Uniswap. Okay? Easy enough. So, with that, I'm going to give an example where you can interact with one protocol, get good revenue share, get token incentives for that protocol, and then leverage it into another protocol of two who are working together. The example I'm going to use is Vesper and Frax. So Vesper is a DeFi yield aggregator, meaning it is an umbrella on top of all of these. It looks at this, it looks at this, it looks at strategies that connect them, and it determines the best place to go out in the world and earn you yield. You deposit Frax tokens to Vesper. Frax is an algorithmic stablecoin that tracks to $1. Billions in issuance. If you do not feel comfortable with Frax, there's ways to get exposure to it without risking it. We will not get into that here. You can deposit your Frax into Vesper and you get paid 6%. That is revenue share from the Frax going out, doing work, generating yield. You also get another 0.5% in VSP tokens. That is a token incentive enabled by Vesper that's saying, I will pay you in my governance token to stick your money here rather than somewhere else. Awesome. Now, 6.5% is good. It's not great. Here's where it gets exciting. I can deposit into Vesper, and I have a tokenized receipt of my deposit. I can then go over to Frax Finance because Vesper and Frax have a partnership that was approved by the token holders. It went through governance voting. Frax emits governance tokens to all these different protocols that support the Frax stablecoin, and that translates to a lot more yield. So you can take your deposit, you get Frax, you deposit to Vesper, and then when you deposit it, you get basically a tokenized receipt of your deposit. You stake that tokenized receipt onto Frax, and you get on top of 6.5%, on top of this, you also get this right here. You get, and this is APR, not APY, so APY is much higher. If you stake, you get a minimum of 20%. And then over here, I won't get too deep into this because this is not the point of the video, but you can choose to, whoops, I need to move this. You can choose to lock up your stake for a certain number of time. For example, if I lock up for a year, there you go. If I lock up for a year, I get a 67% boost to this rate. I go from earning 20% to earning whatever that is, 35%, 32%, somewhere in that range, on top of this other stuff. So at a minimum, no lockout, no whatever. You don't hold any Frax governance tokens to multiply your weight. You earn 20% plus 6% plus 0.5%. That's close to 30% APY. And the risk that you're taking on is not 10 times greater than what you would get with 3% elsewhere. All it's doing is it's exposing you to multiple layers of leverage where you're taking the same thing you're doing, you're putting it somewhere else, and that leverage is parked in a place where they are paying you to do that with those token incentives. You can see I have some of my stablecoin on Frax. You can see I have this much, and I've already earned, at least since my last claim, this amount. So I've got close to 3K here just from the 20%. I'm also earning the 6%. That's not tracked. They're separate. So that's the high level TLDR. You want to find protocols that are worthwhile and have good revenue share. If there's no revenue share, if it's just token incentives, if you're getting asked to lock up a token just to lock up a token, you're getting paid more in that token. That's a Ponzi. That's not what we're doing here. Okay, it's fun. It's fun to gamble on those. That's not a safe place to get passive income. This is passive, okay? You're earning revenue share. You're earning token incentives from people who are paying you because they want you to get that revenue share, because they want to eat this market, and the quickest way to eating this market is by getting as much deposits as possible. And you are basically hitting multiple of these simultaneously by figuring out ways to leverage between one another. So that's really, that's what it comes down to. That's DeFi. Once you understand, that's all that. Once you understand that, whatever the multi-trillion-dollar finance market is valued at, once you understand it's just this, it becomes a lot easier to justify this. That's that. Hope you guys enjoyed.